Hello everyone, I'm Gregory Schnese and let's talk about Bitcoin Borrow Die. As always, these videos are for educational and entertainment purposes only. They are not tax advice or financial advice. This week we're going to look at what it takes to generate $1,000 per month through three different Bitcoin loans at three different LTVs, and then also looking at Stretch, STRC from MicroStrategy, and just kind of comparing the four different options. So as I already said, our mission here: generate $12,000 per year, $1,000 per month. What does it take at the end of 2025 to hit these numbers? So for the first bucket, this is the Bitcoin Borrow Die strategy where we borrow against our Bitcoin. So pledge Bitcoin, take out USD loans. We're assuming a 10% interest rate and a CAGR, a compound annual growth rate of Bitcoin at 25%. This is a little bit more conservative than Michael Saylor's Bitcoin model, but that's fine. We're just trying to keep very realistic numbers here. And then we're looking at this over a 10-year window. So some of the benefits of the Bitcoin loans: they're very tax efficient. So the loans come out as debt. There's no taxable event. You hold onto your Bitcoin, so you appreciate in the full upside, which is a really important part. And then for both of them, for Stretch and for Bitcoin loans, your heirs would inherit the asset at a stepped up tax basis. So that's really important too. And then for Bitcoin loans, there's volatility risk, interest drag. If you're paying 10% interest and Bitcoin has a flat year or goes down over year, it does eat into your equity. And then active management. So you really have to keep an eye on LTVs, which is why I created Margin Watch. And you'd want to just make sure that your LTVs stay within your range. And we'll get into the three different LTV buckets in a moment. And then the other option to consider here, this is kind of like the income part of your portfolio, is MicroStrategy has a bunch of different perpetual preferreds now that offer a yield, but Stretch is a really, really interesting one, and it's their newer one, where they basically want to keep it at $100 per share and pay out around 10% per year in interest. It's currently 10.75, but we're just using 10% to keep things easy. That's per year, and then they pay it out monthly. And the benefits of a Stretch type product is you literally have to do nothing. You just buy the thing, and then they pay you monthly, and then that's about it. The tax is deferred until you sell. It reduces your cost basis over time. It's a very slick product. And then some of the pros and cons for Stretch is just stability, simplicity, and then diversification. So looking at Bitcoin and our loan products and just how these work, it's also nice to have just a simple income side of the portfolio where it's just generating cash flow for you. Whether Bitcoin goes up or down, bull markets or bear markets, you don't really have to worry about that part from the income part of the portfolio. And then the cons are there's no appreciation. It's supposed to stay at $100 per share. So you would not expect your share of Stretch to appreciate beyond $100 because strategy is going to be there selling to keep it below. Tax drag, well, this is over after 10 years. They're tax deferred, so they're actually really great on the tax side. And then the opportunity cost, just where are these funds coming from? A dollar that you put into Stretch is a dollar that you can't put into Bitcoin or elsewhere. So you have to just figure out which works for you. But kind of getting into the meat and potatoes here, where we're looking at our yearly income. So we want to generate $12,000 per year, $1,000 per month over 10 years. And then what does this look like? What is this required? So if we take out a Bitcoin loan at 15% LTV. This is looking at the peak LTV over the 10-year period, and the peak is around year 6. So we want to keep our LTV below 15% the entire time. So given Bitcoin's price of about 88,000 now, we would need about $160,000 in collateral. It's about 1.8 Bitcoin, and then we would generate $12,000 in income. And then the same thing for the 30% and the 50% loan. As our LTV increases, the risk increases, but the required collateral decreases. So if you wanted a really conservative, mostly worry-free, I mean, quote unquote, but 15% LTV is very conservative. You could go lower as well, but your margin call would be much, much lower. And then as your LTV increases, you would need to pay attention to it a lot more, but then the required collateral is less. So depending on your risk appetite, this is what it looks like to generate $1,000 per month with Bitcoin at its current prices and how much collateral and Bitcoin you would need to put up. And then kind of shifting gears a little bit here with Stretch. So we're assuming that it's going to pay 10% per year. You would need $120,000 in collateral, or about 1.4, 1.3 BTC, and that would pay out $12,000 per year, like $120,000 times 10%. And then that's how you would get your $1,000 per month here. So with a conservative Bitcoin loan, you're about 1.8%, and with Stretch, you're about 1.4%. At the end of this period, though, you would still have your Bitcoin, which is very interesting. So this is just walking through the this 30% yield, or this 30% LTV loan by year for 10 years, where we would start out with a loan amount of $12,000. We're assuming, a 10% interest rate. And then you would want about 0.9 BTC to cover this for the whole time. So if you put up 0.9 BTC today and did this, your LTV would be quite a bit lower than the 30% target, which is great. So you would start off extremely conservative, but you're taking out 12 grand in year 1 for a loan to get $1,000 per month, and then you're paying that off in year 2 by taking out a loan to pay off year 1 and just rolling that going forward, which is why you need to put up more. Well, you're not putting up more collateral, but like your LTV, if you wanted to keep your LTV very low, you would need to increase your collateral, but we're targeting 30% LTV here, which is why we're way over collateralizing in the early years to keep it at 30% or lower. And in year 6, that's where it starts to peak. But then as we assume Bitcoin appreciates at 25% per year, as we've seen in other videos, our LTV starts to drop because Bitcoin's growing faster than we're taking out our loans. But this is just kind of like a 10-year walkthrough of the 30% LTV. So kind of looking at this from the upfront BTC capital efficiency, what you need to put up to start this if you were to do it today. With a 15% loan, again, it's like 1.8 BTC, stretches about 1.4, and then it kind of goes down as you take on more risk. So it really depends on your risk appetite and what you would want to do to generate this $1,000 per month. And then which strategy wins, very dependent on who you are, what you're doing with your portfolio, what your risk appetite is. But one of the great things of the Bitcoin borrow die strategy is that you hold on to the BTC, so you participate in that 25% growth year over year, and you still have your Bitcoin at the end. So like when we go back to our 30% LTV here, our loan value is about $191,000 after 10 years, but our collateral has like 7x'd from year 1 to year 10. So we still hold on to our Bitcoin and we could continue to roll with this. Oops, hang on. And then if you want something more of a stable case, so this is the argument for like the income portion of a portfolio. Bitcoin loans can do that, but also something along the lines of like a stretch or dividend paying stocks are interesting as well, because it's really set it and forget it. If you have hit your Bitcoin goal or have money coming in from a different source, or you want to start to build out this side of your portfolio, it's good to do because you just have a portion that's generating income, whether it's a bull or bear market. You don't really have to worry about that part. The only kind of drawback is a dollar you put into like stretch, you can't put into MSTR or into Bitcoin itself. So you just gotta have to make this decision on your own. And then it's kind of like a blend where how you want to bring in this income, either through the rolling Bitcoin loans or through preferred perpetual stock like stretch, is up to you. But this is just kind of a walkthrough of what it would take to generate $1,000 per month. And then, of course, you can run your own numbers at Bitcoin Borrow Die. Take a look, see how you feel about your different numbers, your model. You can go out past 30 years. But I just wanted to walk everyone through what it looks like to generate $1,000 per month through Bitcoin loans or through stretch at the end of 2025 here. I hope everyone has a happy new year.